Welcome. Yeah. So hi everybody and welcome to our monthly webinar. The whole Ambit team is here, Aishwarya, and I am also here to take you through the highlights of this month, the theme that we have this month, and some of the details on the macroeconomy. And post that, we will be more than happy to take up your question and answers. In the meantime, if you have any questions, do keep writing it either in the Q&A box or in the chat box. So without much ado, let's start with this month's webinar. So first up is the portfolio performance. The last couple of months have really been very, very kind, not just to the markets in general, but also to the Ambit portfolios. And as you can see, after a very stellar performance last month, again, we managed to outperform the market. Our coffee can portfolio did almost close to 6% returns, outperforming the broader markets by a factor of almost close to 2.1 percentage points. And now we are up almost close to 5.5 percentage points on a 3-month basis. We are up about 2 percentage points on a 6-month basis. We are marginally up about by percentage point on a 1-year basis, right? And almost in line with the market on a 2-year basis. And the CAGR of returns on a post-fee basis since inception stands at a very rock solid 19.3%. And this is something that we've kind of always maintained about Coffee Can, that it's a portfolio that is always going to be steady return. It's a portfolio that has rarely delivered below 18% on a since inception basis, and kind of hovers between the narrow band of 18 to 24% in terms of the since inception CAGR returns. The returns have never ever been negative in any single calendar year, and CY22 is turning out to be no different. We are back in the positive now. In fact, if I may say so, as of end of today, we are largely in line with the market, and we are up about by 1.5 percentage points or thereabout. Well and truly on course to deliver another double-digit return year for all our investors. So like we always say, that quality always pays. It's never ever about trying to time the market, but as my friend Aishwarya always says, it's about trying to spend as much time in the market. Equities is a product which is meant for patient investors. Equities is a product which is meant to compound your wealth, multiply your money. And if you're not doing that over a long-term period, then really, this is not the best asset class that you have. Moving on to the second one, which is Ambit Good and Clean portfolio, delivered again a very, very steady, close to 3.5 percentage points return in the current month on a YTD basis. CY22, we are almost in line with the market with positive 3.3% return. And what is remarkable is that on a 7-year plus CAGR basis, we are up about 14.1%. returns, right, on a post-fee basis. Very rarely have I seen any mid-cap portfolio, any mid-cap fund delivering returns as consistently as this one has, and yet over a 7-year period has been able to deliver very, very steady low teens kind of a return, right? And that's the beauty of Good and Clean. The superstar product that we have, which is Ambit Emerging Giants, delivered 9.1% return in this current month, outperforming the broader markets by closer to 3.2 percentage points. We are up about 2.3% on a CYTD basis this year as compared to the broader index, which is down about 2.7%, delivering almost close to 17% return on a 4-year plus period that we have, outperforming the broader market by a whopping 6 percentage points plus. We are now outperforming the markets by close to 8 percentage points on a 3-month basis, closer to what, 4 percentage points on a 6-month basis, closer to again 4.5 percentage points basis on a 1-year basis, and largely in line with the market on a 3-year basis, and on a 2-year basis, marginally below. But again, I've never seen any other fund which has been able to perform as consistently as Ambit Emerging Giants has, when it protected your money in 2018 and 2019, and yet delivered 40% plus CAGR returns over a 2-year period in 2020 and 2021. And when we have hit a rough patch again in this current calendar year, which is 2022, the fund has again showed its true colors. It has again emerged out as a winner, is in the money when the overall market is in the red. Now for my favorite part, which is our latest baby, our smallest kid, Ambit TenX, has delivered close to 7.3% return last month, which is an outperformance of close to 1.5 percentage points on a 1 month basis, is up about 4.5% on a very small time frame that we have, whatever little 7-month time frame that we have, as compared to the broader market, BSE 400, which is down about 1.4%. So that's essentially what Ambit has been able to do. That is essentially what quality investing is all about, which is about investing and being patient, continuously doing your due diligence, continuing to believe in quality, continuing to stay invested through good and bad times, and the returns always come through. It's never a linear journey. It's very rarely a linear journey. But at the same time, when the returns come, they come bunched up. But quality always pays. And that's essentially the key message that we are taking away from this. But what is the cornerstone of this steadiness of our performance, this strong comeback that we always manage to deliver, this strong comeback that we always manage to stage? That's the key question that I think you should be asking. And the cornerstone of our philosophy has always been about earnings growth. We always behave and believe that we are business owners and we are not equity investors, we are not stock investors. And that's essentially what has paid off in the current quarter as well. Even through the time from Jan to June, when the funds were underperforming, the earnings growth never got hit. And that is essentially the reason why we believed that the performance is always going to come back, because the quality was intact in terms of the balance sheet, in terms of the P&L, in terms of the corporate governance practices, and the earnings growth. So if you look at in the current month, Coffee Can on a maiden basis delivered close to 34% revenue growth as compared to Nifty, which delivered close to 21%. Margins were largely intact in this current month, which was a bit of a surprise. 35% maiden EBITDA growth as compared to the broader market, where we continued to witness margin compression, 12% EBITDA growth, and 38% profit growth as compared to the broader markets, which was delivering almost close to 20% earnings growth. But the key point here, the point to note, is the base effect, right? On a 79% profit growth quarter, we've been able to achieve 38% earnings growth in this current quarter. And that's what Coffee Can stands for. And that's essentially what we aspire to do. That is what we target to do. And that's essentially what we manage to do quarter after quarter, every quarter. Good and Clean delivered a very, very healthy and a very robust 44% maiden revenue growth, almost in line with the Nifty mid-cap index, which was about 47%. But the key thing over here is that intensity of margin compression was significantly lower than the margin, the overall market. We managed to deliver a positive 26% EBITDA growth as compared to the Nifty mid-cap, which managed to deliver just about a 16% negative EBITDA growth. So the outperformance was very stark and very, very significant. Then Ambit Emerging Giants delivered 38% maiden basis EBITDA revenue growth, which was again in line with the market, and the margin compression, which was again lower as compared to the broader markets, which is essentially 25% EBITDA growth as compared to the base indices, which delivered close to just about 20% EBITDA growth. So solid double-digit EBITDA growth, solid double-digit profit growth across all the portfolios, despite the base effect that we have witnessed, despite the base effect that we had. And that's essentially all about the quality of the portfolio we have. But I do feel that this is just not enough a color to be given to you. So what I would do is I would request my good friend Aishwarya to come and give us an update on the quarterly results that went by, what are the key trends that he saw, and give some update on the macroeconomic situation of India. Aishwarya, back to you.
Thank you, Manish, and good evening, everyone. Hope everyone is doing great. So we saw what happened in quarter one. It was a I would say, very surprising quarter, given the expectations were quite muted. And even on quarter two, where the expectations of very steep commodity prices and its eventual impact on this margin is now taken a backseat. Now, if you really look at how things are playing, I think you just saw the numbers which Manish was discussing about our portfolio. But even if you look at the indexes number, you have seen that there was a 20% PAT growth year on year, in spite of a 46% 46% high base which was there. So one thing which is very clear that, India is making a very strong comeback. We know that, all the latest development which is happening, especially in Europe and US, there is a clear-cut sign that there is a strong derailment of growth which is happening. And on top of it, the geopolitical tensions, ongoing war which are happening, has come in sync with when the central banks are contracting their balance sheets and wrapping up their monetary policies, expansionary mode. So it's like a very, very tough situation globally. And in spite of all that, the resilience which India is showing is of a different class, right? Obviously, on inflation side, India has shown more resilience compared to others. But what is more heartening is the way we are showing our demand. And that possibly is one of the reason, that why FI, which has sold heavily of almost like 2.5 lakh crore over the last 9-10 months before till June, have seen almost 50,000 crore of buying so far. So if we see this quarter results, there has been a mixed bag. There are certain sectors which haven't done pretty well. BFSI has shown very good traction. Consumer discretionary, home building, those were the one which really showed very good growth. IT was something which had a mixed set of trends. So, if you look at the large cap IT, have shown that there is a kind of slowness which is kicking into the system, where we have seen that many of those large cap IT didn't perform as what was expected. But large part of the mid cap companies, especially on mid cap IT, have shown us decent result. We understand this because managing revenue growth of a large cap and margin is much more difficult compared to mid or small cap companies, because the ticket size itself is small, compared to large. I think that pressure will be visible even in the mid and small cap entities in the coming quarters. But if you look at to the other sectors, right, especially consumer, the consumer, we have been very upbeat about it. That's why we have a very healthy allocations to consumer discretionary names likes of Titan, Page, in Coffee Can, in GNC, even in emerging giants, where the consumer discretionary sector have reported very strong revenue growth and margin, right? And we are in that camp which believes that possibly this festive season, extrapolating the commentary which we are hearing from the management, is going to be one of the best festive season we have seen in the recent history. If you look at the companies which we own, whether it is Titan, Metro, Asian Paints and Page Industries, Safari, which is one of our sparkling investment into emerging giants, have shown very strong growth. There were a couple of stocks or segment like, Relaxo or possibly Orient, which failed to impress us, and we believe we are very confident that they will pick up, the lost ground. But large part of our consumer discretionary exposure reported very, very robust growth. Even on the staple side, we saw a very strong delivery by ITC, and ITC obviously is one of very good, I would say, outlier from performance perspective, and even Nestle delivered a very, very consistent performance. Now, moving on to the next sector, which is one of our favorite. We have been very vocal about it over the last 1.5 years. And I believe the whatever numbers that we have witnessed on the indices level, there's a huge amount of polarization, because banking is one sector which has contributed to the large part of the gain which we saw in the index, from sales to profits to PAT. But we believe that this trend will continue. The credit momentum, is ranging between 14-15% fortnightly year on year, is very, very healthy. We have seen certain banks are now coming up with tier 2 bonds issuance. It clearly indicates that they are preparing for that liquidity to manage the credit growth, which is picking up, because the deposit growth is hovering around almost only 8 to 9%. The best part is, obviously we saw some operating performance issues because of higher OPEX and certain treasury losses because of the wild swing in the 10-year on the other investments. But we believe they were like more of a one-off, and because of a very comforting asset quality, the recovery in slippages and possibly the lower credit cost, high healthy advances will foster very strong growth for banking for the next year and a half. You can clearly see in front of you, see how the GNP of the private bank and the PSU banks have seen over the last 15, 16 quarters. And that is very, very comforting. Moving ahead on to the other sectors, like, pharma is one which continues to remain under pressure, primarily because of the generic price pressure in US. But we have seen, that's why we don't have any investment into that particular theme. We are more focused on India. We like more of APIs and the intermediates and people who are into the contributor to the pharma story rather than the final formulation players. Obviously, India, we own Torrent Pharma, which possibly is more India, and we have seen that the India portfolio, has shown very decent growth, led by the recovery in the chronic and some stabilization in the acute portfolio also. But overall, I would say scenario. We were initially perturbed with that there might be some slowdown in the rural space, especially in the tier 5 and below, and possibly in the rural side. But looking at what the companies like HUL and ITCs, and when you're hearing about the management commentary about them, possibly that the slowdown will not be that big an issue. We have seen a very healthy monsoon. The water reservoir level is pretty good. MSC price hike and possibly the very strong non-farm income will continue to push the rural income, and that should be able to manage the overall growth scenario. So revenue growth will be robust, and with the steep deterioration in your commodity prices, Q2 and Q3 of this financial year will surprise the street, is what we are believing right now. And obviously there will be polarization, banking stock, consumer sectors, chemicals, those will be the one which will be providing the large part of the moment on the growth side. Overall, one important point here is that if you, as I was talking to you earlier, that India continues to remain very resilient. Obviously, if the global scenario, possibly we believe it will excavate further, the situation will worsen, especially what we heard yesterday, that the gas supply from Russia is expected to be completely halted, and that will have a bigger repercussion in the European GDPs and the economies. And that will not be, I would say, a good scenario to have. And obviously, it's like a Lehman moment for Europe. Obviously, if you look at the US, the growth is definitely a big worry. And last time when we met, after that, we have heard Powell speaking that he will try to, obviously whether he can really imitate Paul Walker, but the message which came out very strongly is that inflation targeting is of paramount importance compared to growth, and we should be prepared for that. More than interest rate hike, we believe it's the contraction of the balance sheet which matters. If you see the last 3-4 months, they initially started with $15-16 billion of contraction. Last month they did a slightly bigger, close to $70 billion of contraction, but we should be aware that there's a $9 billion balance sheet which has been expanded, and it will take possibly years to bring it down to a meaningful or in a leaner fashion. So the globally things are very, I would say, completely risk off. We have seen dollar index crossing 110. We saw we have 10-year, US 10-year, US 2-year have seen almost like jump of almost 10-15 years. We have seen moderation in commodity prices. There is a clear-cut demarcation about very strong degrowth in a lot of these developed economies. China at best can pull up 2% growth this calendar year. In spite of all this, India is possibly still be able to do 7% growth. If not that, even if you see a worse recession in US, India would be able to pull up close to 5.5 to 6% growth. That will still be the fastest. We saw the kind of number which they reported in Q1, and if we extrapolate this number for next 2 quarters, 10-12% earning growth on a very high base of 40% in FY22. I don't believe any economy of this size will even be able to come closer to what India is standing. That's why we believe, the FIs has tried to allocate higher money to India, and that trend will possibly continue. Next 2, 3, 4 quarters will remain very volatile of all the reasons I mentioned to you there. But in those times, India's, resilience will be proved. And I think it's very, very interesting to see. Obviously, right now, market looks deeper coupled. We have very, very limited impact on our Indian market. So I was looking at this very interesting data that in this calendar year, US market, if you look at Dow, so possibly Nasdaq is down 26% so far in this calendar year. Your Dow and S&P is down between 15-18%. Most of the European market, ex of FTSE, is down between 15 to 25%. China is down between 15 to 18%. Japan is down only 4%, but majority of the developed economy, I just look at the data for the top 10 GDP, are down between ex of China are down between 15% to 25%. India's market, this calendar YTD is positive, 2% in local currency, but that tells a lot about the resilience of this economy. So if I look at, if we just clearly move on to those macro slides that we have, the reason for this thing is obviously the data which is coming, right? Or we have seen the way our government has been able to manage the energy crisis. The inflation numbers aren't obviously we are seeing a moderation both in WPI and CPI. I would say that the RBI has done a phenomenal job of not only creating liquidity and cutting rates when it was required, but at the same time have been able to packing up the liquidity in a very sharp move. So at some point of time, we were sitting on a liquidity of almost 9 lakh crore on the left window. That number has come to close to 1 lakh crore. So we don't really have to worry about inflation anymore. I think the worst of the inflation, at least for India, is there and is over. And with the steep, moderation in the commodity prices because of the looming slowdown fear, I think inflation should not be a worry for India at least. But on the other side, if you look at the PMI data, if I look at the GST data, if I look at the tax collection, if I look at the rural demand, if I look at the way CapEx announcement is happening in the last 4-5 months, if I look at the monsoon, obviously you can all hear about the thunders which is happening, but the monsoon, the sowing around, the credit growth picking up, all of these indicators are telling us that things are coming back up in shape for India. So 3-4 months, possibly 2 quarters, we will remain on our toes, but overall things are looking very, very sanguine. A lot of people say, Aishwarya, that we just saw 13.5% growth in GDP last quarter. Expectations were around 15%. Are we really seeing that, growth slowing down, or is it much lower than expected? I believe obviously we cannot, though we are decoupled, but we cannot remain detached globally. If global GDP and the growth is going to fall faster, we can't say that we are insulated. We will obviously have an impact, but we have to understand that fact that other economies, even our size, are degrowing. We on a high base are pulling up a growth of 13%. On full year, if we can do 6-10%, nothing like that. No economy will be able to pull any number closer to that. So that is what we are getting a lot of comfort from, and we have been talking about this, the whole India story over the last, I think, 15-16 webinars that we have been doing. Obviously, there are certain area of concern. My only concern is BOP. We have been, seeing that our import bill is rising because of the commodity, but at the same time, slowdown in Europe, slowdown in US will impact our export big time. That will adversely impact our BOP and CAD. And with the way dollar is strengthening, there is a good risk that the currency, which we have been pretty resilient so far, primarily because of the buying of, using our reserve. I think we have used almost $70 billion of our reserves. Our reserve level last week were close to $564 billion. And if we use it another $50-60 billion to hold our currency, then we'll be slightly in a precarious situation. So that is what I'm clearly watching, that data. Another thing is, though the rural demand, some of the managements and whatever the numbers we are witnessing, the channel checks we are doing, but we are still not into that camp who believe that rural demand is all hunky-dory. There is a possibility or an element where the rural demand might not show a very secular trend. So there are certain areas we are very watchful about. Obviously, on CapEx side, a lot of announcement, but we will really like to see things moving on that front. So there are certain things we want to witness. And if you look at into the last slide which we have, this is a beautiful slide. I want everyone to have, it's because when we say India is doing good, we have to see India compared to what other developed economies are doing. And if you can see that, obviously this data in the red, which is reflect to India, just look at the real policy rate, which is the fifth point, the fifth column, and our interest rate, repo rate, around at 5.4. Our GSEC with inflation is close to 6.7. So real policy rate is close to negative 1.3, and RBI has taken up a tack to make sure that we comes into positive real rates, which will be conducive for our economy. We believe it's very likely RBI most likely will have to increase rates by another 50 bips just to follow Fed, because see, when Fed increases rates, then there is no option left for the emerging markets economy and their central bank, because if they don't raise rates, then there will be a flow of money which will happen from those emerging market to developed market, including Fed, and there will be a big risk of currency depreciation. So even countries like South Korea, countries like Taiwan, and all, they have to, just follow the Fed, and possibly India is not an exception. So we expect a 50 bips hike by RBI, possibly 25 in two spaces or one hard 50 this calendar year itself, and moderation in inflation by 50-60 bips over the next, say, 3 to 4 quarters. So 3 to 4 months will possibly bring our real policy rates in positive territory. China, which was holding this policy rate in positive territory, has slipped into negative. But look at the data for US and UK and Germany and France and Japan. Japan has been always in negative rate, but we have never seen such scary data, at least in my 15 years of investment experience. Think about it, the US, which is sitting on almost like inflation of 8%, 9%, and when their interest rate close to 2.5% compared to India, which is sitting on inflation of 6% and interest rate of 6%. So eventually money should eventually follow to India, but the dollar supremacy always prevails. But we believe this is the biggest danger to the global economy. If you look at the credit growth side, if you look at the PMI side, various other indicators, the consumer confidence, India is standing very, very tall. Especially if you look at the GDP growth rate, if you look at, this is the seventh, I guess, the seventh column, possibly we grew 13.5%. And look at the growth of majority of this developed economies. So you may discuss and debate that actually this is all developed economies. I've also gone through all of these, developing or emerging market economies. No one is going more than 6-10%. There are certain commodity-based economy which are, because of base effect, are showing slightly higher growth, but there is, I would say, not meaningful GDPs or meaningful market. So that is why India is possibly, it's like a TINA factor which is playing out. There is no alternative to India as we speak. And the visibility about India's growth is the highest. Now, there's another point I want to tell you, that possibly, as I said, we are decoupled from market, but we can never remain detached from the global economy. So if economies in Europe really goes for a tailspin and they really see deep cuts into their GDP, and possibly they go below 6-7 years back, and if US, somehow we believe that US will be able to manage the show, but even if you're on the worst case scenario, if US doesn't pull things in a timely manner, the worst impact on our GDP will not be more than 150 to 200 bips. So the expectations of our GDP growth, which is close to between 7% to 7.2%, we can take around 150 to 200 bips out of that. So we can still grow around 5.5% in a worst case scenario, right? And if we grow around 5.5%, our earning growth will still be high single digit. So even in that scenario, no other economy can come closer to this. Another thing which I get a lot of time from my clients is actually India isn't expensive. Why are why FIs are buying India, which is so expensive? So India is sitting at close to 19.5 times, right? Which is almost at 100% premium to emerging markets. If you see the long-term average, India has traded almost at 85% kind of a premium. So India has always been expensive. There is nothing new to that. I won't say markets are cheap, but I won't even say that markets are expensive. Markets are reasonably valued, and the TINA factor and all the reasons which I was talking here is actually playing the biggest contribution here. So I think it's almost 5:30. It's been a long monologue. I will stop here. And Manish, possibly we can take if there are any questions for any of us. Thanks.